Brad Williams, Frugal Finance, Grantor Trusts. Understanding Grantor Trust rules and overview. Grantor Trusts are a common tool in estate planning, but they come with specific tax implications that impact both the creator and beneficiaries. These rules govern how trusts are taxed and define the responsibilities of the person who creates the trust. Here's an overview of Grantor Trust rules and how they function. What are Grantor Trust rules? Grantor Trust rules, as defined by the Internal Revenue Code, explains the tax obligations tied to trust where the creator retains ownership of the trust assets for income and estate tax purposes. These rules ensure that the creator or grantor is treated as the owner of the assets in the trust for tax calculations, even though the trust itself may hold those assets. Grantor Trust can be either revocable or irrevocable, depending on the terms set by the creator, and they specify how assets are handled and transferred after the creator's death. The legal status of a trust, whether it is revocable or irrevocable, is determined by state law. Key points to remember: a grantor trust means the creator retains ownership of the trust assets for tax purposes. The IRS grantor trust rule applies to different types of trusts, not just revocable ones. Trusts can be either revocable or irrevocable, each with different implications for control and taxation. Taxation of trust. Trusts serve as legal entities in estate planning designed to hold and manage assets for beneficiaries. The creator of the trust can retain control over the assets within a grantor trust, meaning they continue to pay income taxes on any earnings from these assets. This system allows for tax deferral and planning advantages. Historically, grantor trusts were used as a means to shield assets from taxes. In the past, income generated by trusts was taxed at individual income tax rates, allowing the creator to shield money under the personal tax rate. However, the IRS has adjusted these rules to prevent abuse. For example, as of 2024, trust income over $15,200 is taxed at the highest tax rate of 37%. This is much sooner than individual income tax rates, where the highest bracket kicks in after $609,000 in income. Advantages of grantor trust rules. There are several benefits to utilizing grantor trusts. Income tax benefits. Trust income is typically taxed at a higher rate than individual income, but grantor trust rules can provide more favorable tax treatment because the creator is taxed on trust income at a personal rate. Control and flexibility. The creator of a grantor trust has the ability to change the beneficiaries or assets within the trust. The creator may also alter the terms of the trust through the appointed trustee who manages the assets for the beneficiaries. Revocable trust. If a grantor trust is revocable, the creator has the ability to modify or dissolve the trust at any time. This provides flexibility in estate planning as the creator retains control. Irrevocable trust. In an irrevocable trust, the creator may relinquish control, making the trust impossible to amend without the consent of all beneficiaries. While the trust pays taxes on its income, the creator's estate is no longer impacted by these assets. Applying the rules to different trust types. Grantor trust rules can apply to both revocable and irrevocable trusts, but the treatment differs based on the structure of the trust. For example, some irrevocable trusts may be designed to mimic the flexibility of revocable trusts in certain circumstances, resulting in what are known as intentionally defective grantor trusts. In these cases, the creator continues to pay taxes on the trust's income, but the assets held within the trust are not included in their estate. Irrevocable trusts often serve to pass assets to beneficiaries while minimizing estate taxes. However, the transfer of assets to an irrevocable trust could be subject to gift taxes depending on the value of the property at the time of transfer. When is a trust considered a grantor trust? According to the IRS guidelines, a trust becomes a grantor trust if the creator has a revisionary interest of more than 5% in the assets of the trust where they transfer assets to it. This revisionary interest means that the creator might regain control over the assets in the future. Common examples of grantor trust rules. Some examples of the power granted under the rules include the ability to add or change beneficiaries, borrow from the trust, use income from the trust to pay life insurance premiums. These powers are significant for those looking to maintain some control over their trust assets while still reaping the benefits of tax treatment as a grantor. The role of tax shelters. A tax shelter is an arrangement where assets are managed in a way that reduces or avoids tax obligations. Grantor trusts were once seen as a tax shelter as they allowed income to be taxed at individual rates instead of trust tax rates, which are often higher. Can the grantor be the trustee? In some cases, the grantor of a trust can also act as the trustee, particularly if the trust is revocable. This allows the grantor to have control over the assets and to modify the terms of the trust as needed. When the grantor dies or becomes incapacitated, a successor trustee can be appointed to take over the management of the trust. In conclusion, the grantor trust rules are an important aspect of estate planning, giving creators flexibility in managing assets and controlling tax outcomes. These rules determine who is responsible for paying taxes on trust income, the ability to modify the trust, and how assets are transferred upon the creator's death. Whether revocable or irrevocable, grantor trust remains a useful tool in tax and estate planning. If you have any questions about grantor's trust, or if you're an expert in this area, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.